Hey everyone, Patrick Jackson with Mann Mortgage here with this week's market updates. Today is Thursday, October 13th. It's about 10:30 on the West Coast. I wanted to get this one out a little bit earlier to you guys today because we got new CPI inflation data. You know, the Fed's favorite way to measure inflation, and like we've talked about many times, inflation is what drives interest rates. So I would love to tell you we got good news to share, but unfortunately, inflation came in a little bit higher than expected. It came down a little bit year over year. It went down to 8.2%, but it was expected to go down to 8.1%. And that core rate, the core rate, which they really love, which strips out energy prices and food prices, went up to, it was expected to come in at about 0.5%. It went up to 0.6%, which drove it up to 6.6% year over year. And the markets have not reacted positively. I believe last week when we spoke, that average 30-year conventional across the country was at about 7.505. And we're at about 7.20 today. So I believe that's over a 20-year high in mortgage rates. So fun news there. Let me share this with you guys. So, there is some reason to be optimistic. So like we talked about before, this kind of shows the year over year numbers each month of the inflation rate, the core rate with those food and energy prices pulled out. And we knew going into the summer it was going to be tough because these numbers down here, July, August, September, are all really low numbers. So any sort of increase we get with those numbers, over the last few months would show up in the year over year. But once we're past the September number now, going forward, we have higher numbers. So we should be coming in lower, and that should make the year over year number come down, make that core rate come down, and hopefully make interest rates come down. And maybe the Fed decides not to keep hiking as much as they have been. The second thing we should be optimistic about, besides these numbers, is that those Fed hikes. The Fed have been hiking their rates, 75 bips here, 50 bips here, and those aren't immediate. When they do that, it's not like someone snaps their finger and inflation comes down across the country and prices immediately lower. It takes a while for those Fed rate hikes to get out in the wild and get in the economy for it to have any sort of effect. So those rate hikes they've been doing should start showing up, in the inflation numbers. So that's something to be positive about, so as we go forward, we should start seeing that happen. And then, this sounds bad, but if unemployment numbers start going up, which we're starting to see some cracks in the labor based on recent numbers, full-time employment's going down, second jobs are going up. Looks like 45 and older are going up, which shows maybe people going back into the workforce, which doesn't indicate a positive thing for our country. So, with that happening, which again, not good for people on their jobs, but that will have a positive effect on the Fed's thinking and will trickle down into to interest rates. So, and another thing I wanted to talk about besides that stuff is coming over here. Oh, didn't bring it up. So inventory. So besides, with the volatility in the markets, so it makes people think about 2008, the housing crash, all that kind of stuff. So back in 2008, we had a ton of inventory going into that period. There was an inventory glut across the country, whereas now that is not the case. This chart right here will show you between September 2019 and September 2022, a percentage shift. So, 50% blue up here means that there's more houses by 50% compared to 2019 now. And then the red is 50% less. So as you can see, most of this, obviously a big portion of it, there's no change really, but mostly reds and peaches and pinks showing that there's been a decrease in inventory levels over the last 3 years. Whereas Idaho, parts of Texas, some Arizona, it looks like they've had some inventory, issues where it's starting to increase. But the reason that's important is, like I said, back then, not only, did rates get high and it become harder for people, that kind of stuff, but it also, we had, demand went down, but we also had inventory go way up, where in this case, we're having demand go way down, but inventory is still down in most parts of the country. And so that's not good for, me as a lender, or you as a realtor, or even buyers necessarily. But it is good for current homeowners because that should be price supportive. That should keep their current home prices in the same ballpark that they are now. Not that there might not be a little bit of a decrease in certain areas, but we're not expecting 2008 sort of drops in value because there's just no housing available across the country for the most part. Again, some areas there is. So coming out of there, so where does that leave us? Obviously, this is not, good for the market. It makes everybody a little bit tougher for everybody, whether you're a lender like me, a realtor, or a borrower, somebody looking to buy. But it also does create opportunities, for buyers, borrowers. Right now, we're seeing a lot more seller concessions. That gives them a little bit of something they can work with. We're seeing price reduction, so that's a little bit helpful. So that offsets the rates a little bit, and less competition. If there's not 15 offers on each house when rates are really low, that makes it a little bit easier to actually get a house instead of putting in offer after offer and not being able to get there. So that, there is some opportunities in the adversity. And then, for lenders and realtors, obviously, with rates being this high and people not being as interested in buying homes, that definitely makes our jobs harder. But it also creates opportunities for us where, in my industry, I know that some lenders are no longer, doing loans anymore, or looking to work in different industries. You're seeing some banks back away from some programs like construction or portfolio lending, or even some lenders going underwater. So that creates opportunities for for me to pick up, somebody, a realtor like one of you guys that maybe was working with a lender and is no longer doing the job anymore. So, if you're in that situation, if you were working with someone that offered construction loans and no longer do that, if you were working with someone that's no longer in our industry, feel free to reach out. With Mann Mortgage, we're still going strong. No matter how the markets be, we're still adding to our portfolio. We're still adding to our programs. We're still got doors open. And no matter, like I said, no matter what the markets turn to, we'll continue to do that. So if you need anything at all, please don't hesitate to reach out. That's all I really had for you guys. Hopefully by next week, maybe we'll have a little bit less volatility. But like I said, we'll probably see, not too much movement down, until we get, at least to that next number coming up here, November 10th, I think will be the next inflation data. So maybe, beginning of November, maybe we see a little bit of softening. But that's going to carry over in the spring, and where we'll really see maybe some decreases. So I hope you guys have a great day, and I'll talk to you guys soon. Thanks a lot.